Aloha, inspired moneymakers. I'm Andy, your host and financial advisor at Runnymede Capital Management. Welcome back to the Inspired Money live stream podcast. Today we're talking about building wealth through real estate investing. American industrialist and philanthropist Andrew Carnegie once said, 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all industrial investments combined. That is a huge statement coming from a man that the American steel industry made one of the richest Americans in history back in the 19th century. By training, admittedly, I'm a stock and bond guy. I like that if I make a bad purchase, I can sell it and cut my losses right away. But I have to admit that real estate is a powerhouse for wealth creation. And the potential for passive income can provide a path to financial freedom. So I'm here to learn on this journey with you. Whether you're embarking on this path for the first time or you're an adept investor already, today's insights are crafted to open your eyes to the opportunities in real estate investing and sharpen your skills as an investor. In this episode, we're going to cover the core principles of real estate investing, due diligence, what it's like to be a landlord, the potential of REITs, those are real estate investment trusts, and then we'll get the do's and don'ts, stories from real estate investors. So let's welcome in our panelists. I'm going to start with Rich Carey, who successfully built a substantial real estate portfolio that began while he was stationed in Germany and Korea. He managed to acquire over 20 properties, I think, when he was abroad, and he did so debt-free. Today, he's retired from the military and living off the passive income generated by his 30-plus properties. Carey's based in Montgomery, Alabama, where he's a realtor. He manages his investments, and you can learn about his wealth building through real estate via TikTok and his YouTube channel, Rich on Money. Rich, it's so good to see you. I'm kind of curious, how is it that you had the idea to invest in real estate when you were stationed in Germany and Korea?
Yeah. Well, so I did a 20-year Air Force career, and I started off overseas. I started off in Guam, which is kind of, a lot of Americans don't even know where that is, but it's out like way, way, way past Hawaii. I had a strong desire to invest in real estate, even though I was stuck in the military, mostly overseas. So I just kept trying to figure it out. But at one point I was in DC and I bought a townhouse that turned into a rental. I kept trying different things. I didn't really land on what really worked for me, which was buying these homes in Montgomery, Alabama, until the 13-year point in my career.
That is cool. So it's figure outable.
Yep.
So I look forward to getting into that.
Sure.
Eric Yu is a real estate agent, an investor, and a developer who specializes in house hacking and Airbnb short-term rentals. Originally from Michigan, he spent 4 years working as a software engineer for Facebook. Eric is known for his investor-friendly approach and his journey from tech background to real estate investment. I think it really shows his diverse skill set and adaptability in different professional landscapes. Eric, can you talk a little bit about what your time was like in Silicon Valley? It sounds like you had panic attacks back then.
Yeah. Hey, first off, thanks for having me on the show, Andy. It's great to see you again. Yeah, my experiences back in the tech world, I mean, it was a great starting point, and I think a lot of the capital that I had to deploy and invest into real estate wouldn't have really been possible without having that solid six-figure income. But it just wasn't really the right fit for me, and I think I always knew that. I was living someone else's life, going down a different path than I kind of wanted. I was living someone else's dream life. And then at some point that kind of just catches up with you, right? So I started exploring house hacking, got into Airbnb, built up a pretty solid stream of passive income. And yeah, rest is history. Left my job a couple of years back and haven't looked back.
That's really cool. We also have Crystal Hammond. Crystal is a multifaceted professional and real estate investor known for her dynamic approach to side hustling. With a full-time career as an engineer, she's diversified her skills into teaching sewing, fitness classes, day trading, social media management, blogging, and real estate investing, notably engaging in house hacking. I think before it became a mainstream concept, she's also co-host of the podcast Stacking Deeds. So welcome, Crystal. I don't even know what to ask you because of all those side hustles. Which ones of those, which is your favorite?
I love the real estate because that's the most passive, I would say. And Eric, I am a Buckeye, so OH, since you're a Michigan guy.
No, sorry, Crystal, we can't be friends anymore.
And that's actually a dress that I'm working on. That's back there. She has one sleeve, but I mean, I like learning and I like teaching. So that's been my claim to fame with the side hustles. If it's something that I learned and it's something that was easy or that came natural to me, I'm going to teach it and I'm going to get paid to teach it too. So that's been two of my fun things to do. When I learn something that was natural, I teach it.
It feels as if there's nothing that Crystal cannot do. And then rounding out our panel this evening, we have Dustin Heiner, founder of Master Passive Income. He's a seasoned real estate investor and educator. He transitioned from a government job to full-time investing, and he achieved financial independence through his rental properties. Dustin is passionate about teaching others to build wealth through real estate, offering extensive resources through his blog, podcast, coaching, and books. And Dustin, I'm curious, like from government job to real estate investing, like how does that impact your lifestyle when it comes for you, not just for you, but your family, your growing family?
Sure. Hey, Andy, and hey, everybody. I'm super glad to be on. And I love talking about real estate. In fact, what I love about real estate is what it affords me to do in my life. It's because now I literally don't work a job. I worked for the local county government in California. And I'll fast forward the story. But after my wife and I had our fourth child, I had the most stable security job possible, which is working for a local county government doing technology. Well, I got laid off. I literally got laid off like a week after my fourth child was born. And I realized, oh my goodness, something needs to change. I need to make sure that this never, ever happens to me again. So I was really blessed to start investing in real estate, found another job, start making money. Eventually I had 30 plus properties. And I was like, man, why am I working here anymore? I'm making $75,000 a year at this job, but I'm losing money. So I quit my job. I laid off my new boss and laid him off. And then now it's really changed my life because it's like Crystal said, it's so passive. I started lots of businesses, and the easiest one, the one that makes me the most money, and the one that I actually have the most passiveness out of it is real estate because my properties work for me. But going from the local county government, where it's literally it's a grind. It was horrible. But now I literally don't do anything, and I have other people do the work for me. And a lot of people have heard of the book, The 4-Hour Workweek. Well, it's a good book, and the premise is try to make your job so you only have to work 4 hours a week. Well, I don't work 4 hours a week. I don't even want to work 4 hours a month. I think working 4 hours a week is for suckers. I only work 30 minutes a month on all my properties because I have people and experts that run the business for me. But going from technology and government to now being financial independent and successful employed, it's amazing. Hopefully everybody can get there.
I hear a recurring theme already, passive income. And you guys are, I think by the end of this episode, I'm going to realize that I'm not doing the right work because I'm not working a 4-day work week. So I look forward to learning a lot from you. Let's start with segment 1. Welcome to the world of real estate investment, a cornerstone of a diversified portfolio that offers long-term returns and tax benefits. But what do you need to know to get started? First, let's demystify some jargon. REITs, or real estate investment trusts, pool investors' money to buy and manage income-producing properties. Zoning classifies properties as categories like residential or commercial, dictating their use. Income-producing properties are assets that generate revenue, often through renting. Now, why invest in real estate? It offers long-term financial stability. Whether you're eyeing rental properties, commercial spaces, or even digital real estate, the sector is ripe for financial growth. But success is not accidental. It requires understanding market trends, zoning laws, and investment strategies. And watch out for red flags. Property condition, location, and market trends can make or break your investment. This is your foundational guide, equipping you with the essential tools to navigate the real estate landscape. So, Crystal, I'm wondering if you can kick us off, because given your diverse background, how is it that you got started in real estate? And what advice would you give to people that have multiple interests like you do?
I would say you start with the basics and the fundamentals. Because even for me, my first property, it seems like sometimes the time picks you. You really have to surround yourself with people who know what they're doing, know what they're talking about, and can really guide you. Because no matter what the market's doing, you need a budget. That's the number one top thing you need. So interest rates are high, interest rates are low, this, that. None of that matters if you don't have a budget. I bought my first place. It was by accident. The landlords of the place that I grew up in on the south side of Chicago, they were selling the place. And at the time, I was making $14 per hour also. And I had friends that went to real estate meetings. So I was like, hey, can I go with you to your real estate meeting? I just wanted to meet someone and tell them, hey, buy this place. That's a really great deal. It was a duplex. My mom lived in one unit. I just didn't want them to raise my mom's rent. And they're like, well, if you have a job, you can buy it. And I was like, shut up. And they were like, yes, girl, you can buy the property if you have a job. So, interest rates were 7.5% at the time. But when I did the math, buying that duplex, and coupled with what the portion that the other tenant was already paying, that equaled a cheaper rent that I was already paying. So once you break it down and do the math, hey, it made financial sense for me. So people are afraid right now because interest rates are 7.5%. But if that's in your budget and you find a great deal, just let the numbers tell you what to do. Don't let, the market trends and jumping on or off a trend. Always do what is comfortable with you and what works in your numbers, because investing in something, the one you don't understand, you will lose and you will regret it. So make sure you understand everything and, go within your comfort zone and go within your budget.
That's incredible. That's an incredible start. Eric, can you maybe give us, explain the concept of house hacking for beginners, and how can it serve as an entry point for somebody wanting to getting into real estate investing?
Yeah, totally. First off, Crystal, I agree with everything that you said. I feel like there's a lot of people that are just following along the news trends, seeing super high interest rates, and immediately kind of saying, hey, we can't do this. But it's always about the deal. In up markets, down markets, there's always deals to be found. In terms of house hacking, I feel like there's something daunting about that terminology, house hacking. And I've had people come to some meetups where they're like, oh man, how do I get into house hacking? But at its core, it's just you buy a place and then you rent out parts of it. That's as simple as it gets. So for us, we were primarily looking for places that had either ADUs or looking for multifamily properties. We lived out of ADUs and then rented out or Airbnb'd out the main house. So the way this works, like Crystal was saying, is if you know what your costs are going to be, your mortgage, your CapEx, OpEx, all of those things added together, and you know that you're going to be able to make at least that amount of income, you can live rent free. And there's nothing better than not having a living expense that you need to pay for anymore. I think once that clicked and once the first property worked out that way for us, it was just a no-brainer to just go all in onto real estate.
ADU is
yes,
accessory dwelling unit?
Yes, accessory dwelling unit.
Yes, I
there you go.
I get a star. Rich, can you talk about, because you got started when you were not living close to Alabama.
That's right.
So what are the principles that you had to adhere to when you got started?
I guess if you know when you hear my story, actually, when it comes to investing in Alabama, I did get a start here. And this is something that a lot of military members are able to do. And that is in my case, I moved every 1 to 3 years for 20 years. One of my locations in 2013 happened to be Montgomery, Alabama, but that was just going to be for 10 months. And I came here pretty upset, Montgomery, Alabama, what is there going to be to do there? I definitely can't invest there. But once I got here and got to know some fellow military members who were killing it in real estate, I was like, well, wait a second. where are you buying houses? How much you paying for them? Like, what's the rent? Okay, wait, do you property manager, like contractors? And I figured all that out. And I started very rapidly buying houses. Now, not everybody's in a position to very rapidly buy houses, but this is at the 13-year point of my military career. And I've been trying to do real estate for 13 years. And I've been saving up money and I've been investing well in all these different things. So it just kind of culminated to where that was possible. But in my case, I sort of set up systems while I lived there for 10 months, set up everything I would need, knowing that I knew I'd leave the state, but maybe the country. And I'd set it up so that I could continue investing and continue buying once I was gone.
Talk about that differential in cost, because I think before Alabama, you had bought like a house or property in Washington, D.C.
Yeah.
And that was like the screaming opportunity for you, like your intro to Alabama.
Well, I think it was very interesting because I had a townhouse that I bought. I remember I bought it for $280,000 in 2003. I thought it was the worst mistake of my life. I thought I was overpaying. Obviously, those numbers don't seem too bad right now. When I got to Montgomery, Alabama, I realized that I could buy houses here that were going to rent for $800, $900, $1,000 a month. I could buy them. Back then, I was buying stuff for $30,000, $40,000, $50,000. Before I got to Montgomery, Alabama, I had been flipping houses in DC, and I was using mortgages to buy these houses. So I was buying houses in Alabama for less than half the price of my down payment on my flips in DC. So that was like a huge eye opener for me.
That is crazy. I mean, I know that the prices have gone up since you first started, but yeah, back then it's like, do I want to buy a car or do I want to buy a house?
Yeah. Yeah. So, and I mean, prices have gone up a lot. And of course, when I bought a house for $30,000, it needed a lot of work. But I mean, if you've heard of the 1% rule, and there's this rule that real estate investors sometimes use, if you say buy a property for $100,000, as long as it rents for 1% of that per month or more, it might be a good investment. That's hard to come by. It's always been hard to come by, but it's almost impossible to come by these days. That was an easy rule to meet in Montgomery, Alabama, when I showed up in 2013. We were buying stuff off the MLS rent ready for the 1% rule. So, which basically means like, if you can buy for $100,000, it rents for $1,000 a month. So I was buying as fast as I could.
And it's incredible that you could purchase multiple properties and do so debt free.
Yeah, and I think obviously that's unusual. I know for me, like I was kind of a Dave Ramsey fan in the past, and I was definitely like a no debt person way back in the day. And I had my primary residence paid off in DC, and that was a rental, so it was cash flowing. It wasn't cash flowing great because it's a high cost of living area, and it just wasn't. So when I ran out of money to buy houses in Montgomery, Alabama, I sold that house. I sold my primary residence in DC, and that allowed me to buy, I can't think of the number, but 8 more houses, I think, for cash. So, and those cash flowed well.
That is crazy. Dustin, can you share like how setting realistic expectations at the beginning of your journey, how that helps to pave the way to a successful, real estate investing experience?
Well, personally, I've found like realistic expectations is everybody's going to have different expectations coming into anything. And so everybody's going to have to really understand my personal perspective as I coach students. It's like, what are your goals? And what are your risk tolerances? You need to know those way before you even care about your expectations. So your goals of how fast do you want to get there? What do you want to do? And how are you actually going to build the business? Now, the biggest thing, so it's not managing expectations, it's actually managing your business. So I'll give you a quick example of how I screwed up. So when I first started investing in 2006, I followed those quote unquote gurus. I went to like this, they said, hey, we're coming to your town with a free 2-hour seminar. I went there and there was a hype and sales pitch. And they said, run to the back. And so I ran to the back and bought another $2,000 course and stuff. It was really, really bad. It was all sales pitch. But what they taught me was what everybody else teaches this, and it's the wrong way. So what they told me really quickly, and I want you to forget it, because when you think about what to do it right, the right way is to build the business. But what they did tell me was you find a property anywhere in the country, and then you run the numbers, making sure you're making, $50 a month in passive income. And they said, you're going to get appreciation. Remember, this is 2006, before the crash, and so prices were going up. I'll pause this and say, I don't invest for appreciation. I only invest for passive income. I invest for $250 or more in passive income. Eventually, I have 30 plus properties. I didn't need to work. So I'll give these properties to my kids in generational wealth. But with that, the wrong way, they say, run the numbers, make sure you're getting appreciation. Then you spend thousands of dollars to buy the property. Then you spend thousands of dollars to fix up the property. And then you find a tenant, and then you find a property manager. Well, in my opinion, that's just about backwards, because I've had lots of people come to me and say, Dustin, I bought this property, did everything those gurus said, and then I tried to find a property manager, and the property manager would tell me, no, I will not manage that property because I'll get shot there. Well, you no longer have an asset anymore. You have a liability. Instead, and this is the thing, instead of expectations, what we want to look at is building a business. And what I love to tell everybody is we build the business first so that it can run for us rather than us doing the work. And the biggest thing about building the business first, let's say you find the right realtors, inspectors, property managers, plumbers, roofers, insurance agents, mortgage brokers. We find all the experts. The great thing about doing this is you will absolutely have experts telling you how to do it right. In fact, instead of calling up a property manager, say, hey, property manager, I just bought this property, and they say, no, I won't manage it. Instead, you say, property manager, I'm looking to buy this property. Tell me how much it rents for. Tell me, what's the clientele like? What's the vacancy factor? And will you manage it? If they say no, well, then you don't waste the time and money buying that property. But if they say yes, they'll tell you how much it rents for, all the clientele, the vacancy factor. Now you have an expert who literally lives there on the ground telling you how to do it. Because what I wanted to do was I wanted to quit my job, be financially independent. I knew that I needed enough money to cover my expenses. And I remember my wife said it was $4,200. That was mortgage, insurance, all that sort of stuff. And I realized if I bought one property at $250 a month in passive income, well, that's $3,000 a year without working. 10 properties is $2,500 a month, $30,000 a year without working. 20 properties is $5,000 a month, $60,000 a year without working in passive income. And it was just scaling the business from there. So if you build the business right, you do it first from the beginning, had the experts telling you how to do it, then you just scale the business. In fact, every piece of property that I buy is a piece of inventory that I put into my business. So hopefully that all makes sense, but that's really what you need to do, in my opinion, is build the business so that it runs on its own.
That's gold. How not to get shot. I like that. So let's go to segment 2. Unlocking the secrets of successful real estate investment starts with mastering the art of property selection. Financial readiness is your first checkpoint. A minimum 20% down payment is often the entry ticket. But what about risks? They're inevitable. But with strategic planning, you can mitigate them. Tools like quantitative risk analysis are your allies here, quantifying uncertainties to inform your decisions. Now, let's demystify some terms. Due diligence is your all-encompassing property appraisal, covering legal and financial aspects. Risk mitigation strategies could be as simple as diversifying your property portfolio. And don't underestimate the impact of natural disasters. They can inflate your insurance costs and eat into your return on investment. To sum it up, effective property selection is a trifecta of financial acumen, risk assessment, and meticulous due diligence. And never forget, location is your golden rule. This segment is your compass in navigating the intricate landscape of property selection, a must-have skill for every real estate investor. Crystal, how do you conduct risk assessment for real estate? And do you have tools that you find indispensable?
Well, I would say your most valuable tools are other people, the people that you lean on. A lot of people don't realize that this is also a systematized thing. Like a lot of us on the call, I'm pretty sure we no longer get in the weeds of, this property, that property. By the time it comes to us, someone on our team in our system has done, a lot of the due diligence for us. And another important point is your network is your net worth. So I like what Dustin said about, asking the property manager, hey, is this a good neighborhood? Is this a good property? You really have to lean on the people who know a lot more than you do. So that's what I do. I lean on the right people, the right team. When I was first getting started, I would attend these real estate meetings once a month. And once a month, it was a round table. And so people would talk about, hey, I bought this property for what, like $45,000. I used this contractor, and this is how much we spent on the kitchen, on the bathroom. Like they went line by line of how much they spent. And then they said, okay, now I use this lender to refinance. And this is the amount we refinanced it for. This is the rate we received. And then they said, hey, this is who we use to rent it out. And this is the rent that we're collecting. That kind of information is gold. And you're hearing it from the horse's mouth. And how did I get that information? Surrounding myself with people who were doing the things that I wanted to do. So your due diligence is in leaning on people who are doing the things, and they can give you raw data and numbers. Not a guru that's selling you this, inflated lifestyle. No, we want the normal people, the regular people who are not in it for the money or to sell you something. We are in it for the people who want to share their stories. Just share the numbers and share the good, the bad, and the ugly, because we know that these are not smooth processes. There's a lot of ugly also. So you want to be on a comfort zone where you can, ask people those kind of questions too.
Rich, I think that you started with like smaller properties. I guess I think they were single family homes that you could pay for in cash, but then you did eventually, use some leverage, borrowed money to buy some multifamilies. And I think it goes back to this discussion about having a team, in having a network, having people that you know.
Right. Yeah, I think in my case, that decision, well, I think I started off as like, maybe this is great. Like maybe I don't ever need to have mortgages on properties. Maybe that's this, a way to get rich and to have no risk. I think what I realized is I sort of did the math and looked back over time and kind of ran numbers and stuff. Okay, it's really cool that I got up to this amount of properties, but had I done all that responsibly with leverage, I'd be way better off today. Like I did that math and realized that that was the case for me. And so it's kind of like, well, okay, well then let's start using debt in a way that I'm comfortable with, and you can leverage to the hilt or you can leverage responsibly. And that's kind of something that just has to do with your own personal risk tolerance. Now, for me, when COVID hit, I had a 6-plex and a 4-plex that I had loans on, but I had 20 paid off properties. So I think for a lot of real estate investors who thought maybe for a few weeks or months that maybe they'd never get rent again, they're kind of thinking, maybe I'm ruined. I remember thinking like, man, if I never get rent again, I'm going to be really annoyed. So, I mean, it's kind of a maybe better able to sleep at night, but at the same time, when you're able to sleep better at night, you lose the risks of leverage where you grow faster and make more money. So there's just sort of a balance there that everybody has to realize for themselves.
By the way, your timing on when you decided to start borrowing, your timing was excellent, because I think you locked in at very low rates.
That's true.
Which are much lower than where they are right now.
Yeah, I also bought a personal house at that point, right? A personal residence, VA loan that was, like kind of the big fancy forever home type thing. And it ended up being good timing. It did. Yeah. But I think to Crystal's point earlier, what Crystal said was very important in today's market. And that is, I think a lot of people have only known, these low interest rates, have only known that. And now there's this like, I'm not going to buy a house at 7%. I'm not going to buy it at 8%. I can't invest now. I'm just going to wait till it goes back down. But when Crystal started, right, it was at 7%, I think. And she ran the numbers and it made sense. And I think everybody needs to think that way. You don't get upset and sort of be like, well, I'm mad because things aren't like they were before, so I'm just going to give up on investing. You take the reality that exists now and see if you can make money in real estate. I don't know if they're going to go back down to 2 or 3% in the next 5 or 10 years. It might not happen. It might happen in a year. I mean, but I'm just going to deal with the rates that exist today and make that decision.
That's great advice. Well, I think for stock investors, no one can say, I didn't buy Amazon when it was below $10, so now I can never own Amazon ever again.
Right.
You have to deal with where you are now, and then, where will things be 10 years from now, 20 years from now?
Oh, Andy,
Or
I'll
if
throw out
you're
a random fact about me, just for your audience. When I was in college, I got my Series 7, my Series 63, and I worked for Fidelity Investments for a while. So I just thought I'd throw that out there. So I'm
Nice.
a money guru. I'm an investing nerd as well as a real estate nerd.
Eric, your experience as a Facebook software engineer, does that help you when evaluating property? And do you use any like tech tools to evaluate risk?
Yeah, great question. I always tell people that I think when you're getting started, especially when you're first starting to look at deals, getting very pro at underwriting and just looking at analyses is huge. What I tell people is like, identify your market, decide what you want to do. And then within like a month or two, you should know it like the back of your hand, what is and what isn't a good deal. I had a mentor early on who was telling me that one of the biggest things is if you know nothing about cars and you see a Lamborghini or a Honda Civic on the street, you're not going to know which one's worth more, right? That's the same thing with real estate. When you first get started, you don't know what is a good deal. So the most important thing is to really shorten that learning curve. In terms of like the actual tools that I use nowadays, when I first started, I did write a couple of scripts that would just like automate a lot of the process for me, figure out, like my cash on cash, which is just like a return on the money that you put into the deals. But I found that the software tools, it's good for numbers, but there's always like these little qualitative details about properties that you really can't figure out until you like go into the photos, you go on Street View, or you actually go to the property in person. So I've leaned away from a lot of those automations and do more of it by hand now. But Andy, do you mind if I ask a question to the rest of the group real quick? This is just something I'm always curious for real estate investors. So we were talking about debt a couple minutes ago, and I'm curious if you guys have like a specific amount of like liquidity or capital. If you got to that point, maybe it's like 5 million or 10 million, would you convert all your debt into like all cash purchased assets instead? So for example, like let's say like right now, I've got 10 units, all of them are in debt. We cash flow around 1,000 a month. But if I got to a point where I had 5 million and I could just buy, say, like 5 or 6 properties all cash instead, that's something I would consider. I'm curious for you guys, like if there's that turning point and what number you would need to get to.
I can share a little bit about how I got there. And like I talked about risk tolerances and goals. So my wife's risk tolerance, when I told her I wanted to quit my job, her risk tolerance was, we have too many loans. We have money. Let's pay off some of these loans because I don't want to have this and I don't want to be worried about money. So my risk tolerance was a lot more, just get a lot more debt because I make money. Like, here's the great thing. Everybody here understands this because I don't pay my mortgage on any of my properties. I don't pay my taxes. I don't pay my insurance. I don't pay my property manager. I don't pay for repairs. I don't pay for any of that stuff. My tenants pay for every bit of that. Now, I also make $250 above that in passive income because it's calculated into the rents before I buy it. Just like if I bought a candy bar for 50 cents and if I could sell it for $1, I would do that all day, every day. But if you didn't have that 50 cents and it took you 25 cents, you borrowed 50 cents, cost you 25 cents, that's 75 cents out of your pocket. Then you can sell it for $1. You're going to make 25 cents. You do that all day. Now, for me, what I realized with real estate investing, I could borrow money and make money at the same time. Now, my risk tolerance is I'm completely fine to go with lots and lots of debt. My wife's not. Now, Eric, well, I'll definitely tell you is I am so glad my wife had me pay off like literally, I think 30 plus properties now. And I've invested in hotels as well and stuff. And so with that, I want to say maybe have like 3 or 4 loans at most. And it's so nice that is so much money coming in passive income, but also we don't want to lose the equity or lose that we have equity that we can tap into. I now have home equity line of credits on my properties, on my primary residence. Access to capital is what we need for this great time. It's going to be really fantastic coming up really, really soon to invest in real estate, but you need to have access to capital. So we have that equity in our houses that we could then pull money out when we need it. At least that's how I and my wife, how we got it to where we are now.
How about you, Rich? You were talking about how you weren't borrowing early on, and looking back, you calculate and you say, oh, maybe I should have.
I really think it's going to depend on your personal situation. But if I think of a situation where I'm pretty well off, so I have the option of being all cash, I feel like if you're well off, you don't have the need to pay off those loans. I guess that's the way I'd look at it. You wouldn't be in a position where I would, if you have a lot of equity and you're making a lot of cash flow and you just have a lot of real estate that has loans on it, there's probably a lot of other things that I would do before I decided to start paying those loans off. Now, if I think that your financial situation is a bit more like, I guess maybe more typical, like the average person that might just have 1 or 2 investment properties, and then maybe you're coming into whatever, you're about to retire and your income's going to be lower and you're definitely not getting rich from rental properties. I think the idea of paying down a primary residence or paying off a rental property could be appealing in that case. But I think that kind of when you understand the power of leverage and you understand the power of real estate and how it makes you money long term in many different ways, including tax savings that come from borrowing that money, I don't see the point in paying it off. But I mean, it's a risk tolerance issue.
Any insights, Crystal, from stacking deeds and talking to a lot of people?
Well, definitely. It is the debt thing. A lot of people are afraid, think debt is a bad word, but there is a difference. This is good debt. You are using debt for leverage to create a income producing, asset. So you're not using debt for dinners out, vacations. You're using it for something that's actually going to produce income. It's going to self-replace. It's an infinite loop here. So this debt, I love the real estate debt because it means that I'm, getting money back. It's replenishing itself. It's self-replenishing, not the debt, but the income. And it's a tax break also for that interest. So, and a depreciation. So that's another phantom word that we love in real estate. So people just hear debt and want to run and scream, but this is not credit card debt for fun. This is income producing debt. So you want debt that is producing income.
I mean, it seems like the choice to pay off debt can translate to sleeping better at night, having a little bit less to worry about. Should where we are in the market cycle dictate how much debt you want to have versus how much you don't want to have? Or is it like long-term investing in stocks where if you're trying to buy at the right prices and you've done the work ahead of time, that it's a long-term plan and you're sticking with it regardless of the economy?
Just as an example, unlike the realtor side of things, I have a couple of investors who are going all cash these days. And to Dustin's point, they're pulling HELOCs out on a bunch of these properties. So they still have access to that capital, but it's more a question of, do they want to pay the interest on it right now versus sometime in the future? And I think that's made sense for a good number of people so far, where it's like, right now, interest rates are pretty brutal. If you do have access to capital to own things cash, and at the same time, you can still have access to that line of credit, it works out nicely for you.
Good insight.
I personally like that. Like I was saying, I don't pay the interest, like the principal and the interest. If I buy a house that, I bought it for $200,000, put it down in down payment, well, the balance of that principal is paid by the tenants and the interest is paid by the tenants. The taxes, everything's paid by the tenants. And the great thing about this is whether the market goes up, whether the market goes down or sideways, we make money because we invest in passive income. Now, I personally don't mind using debt. In fact, I love utilizing debt because it makes me money. And on top of that, what I love, because interest rates, even though interest rates are high, because people are really concerned. Oh man, interest rates are very, very high. I can't buy this property. I'm like, I completely understand. Well, if you're going to be, as I'm talking to my students, what I usually tell them is, if the price is too high and the interest rate's too high that you're not going to be making any money, we don't buy the property. We don't go through with it. What we do though, is we offer lower until it makes it work for us in passive income. So we have to lower our purchase price. Now it's a lot harder, especially when prices are still pretty high. Interest rates are really high. But the biggest thing is, as long it's, and I think Eric mentioned this, it's every single deal is going to be different. And so it depends on the deal itself, meaning the property. if you buy the property for the right price, that you have the expenses accounted for, that you could rent it for, in my opinion, suggest $250 or more in passive income. If you're able to do that, it doesn't matter what interest rate, it doesn't matter what price you pay, because like I started investing back in 2006, and in the crash, I was really 2008, I was worried about that crash. Like, oh my goodness, our rent's going to come down. In fact, they did not. They actually went up, because sadly, if their market changes, sadly, people are going to lose their homes and they're going to go to foreclosure. Well, that pool of renters goes up because demand is higher now. My rents just keep going up. So over time, rents go up. Over time, prices will eventually stabilize. So in my opinion, if you utilize interest and do it right by building the business, making sure you have your expenses accounted for, then you're going to be successful. If the market goes up, down, or sideways, you'll still be making money.
I like that. Okay, we're going to go to segment 3. Unlock the power of rental properties as a wealth building tool. The cornerstone, effective tenant management. It's not just about rent collection. It's about screening rigorously, conducting regular property inspections, and being responsive to maintenance needs. This leads to tenant retention, minimizing the cost of churn. Pricing your rental, it's a fine art. You need to know your local market, understand your property's unique value, and keep an eye on comparable listings. Get it right, and you maximize both occupancy and revenue. Legalities can't be ignored. From crafting foolproof lease agreements to understanding eviction laws, you need to be on solid legal ground. This ensures you're not just a landlord, but a smart one. And let's talk long-term. Rental properties aren't just a monthly paycheck. They're a long-term investment. With the right approach, you're not just earning, you're accumulating wealth. Your property appreciates and your portfolio grows, setting you on a path to financial freedom. Now, I have clients who have rental properties, so I've heard stories where the good tenant makes all the difference, because there are those who have had bad tenants and then they said, I do not want to be a landlord. Dustin, can you talk a little bit about, like, maybe you can share a challenge you faced with dealing with tenants, how you resolved it, just as a lesson for somebody who's considering becoming a landlord?
Well, I'm going to say this, and it really comes from, I really wanted passive income. I didn't want to work at all. So I hate talking to tenants. I've done it in the past. I don't want to talk to tenants. So what I do instead, like, I don't want to get the calls at 3 a.m. Hey, the toilet's leaking, or this happened, or that happened, or my son got arrested, so I had to bail him out, so I can't pay rent. I don't want to have any of those conversations. I want to be able to play with my kids. I want to be able to have fun doing things that I want to do. So what I do is I hire property managers. Now, here's the thing. I think Eric might have mentioned this. I put in the systems and procedures and processes in my business so that it runs the way I want to run it. Just like if I started a convenience store or any type of business, we have customers and inventory and everything else at a business, you're going to take your time and hire a manager very slowly. You're going to interview lots and lots of them, interview them many, many times, and hire the right one that's going to take over. So for me, it is a bummer when you have tenants that, let's say, they leave and you have to actually evict them and they leave a big, trash and everything like that. For me, only thing I see, it's a line item as an expense. I had to pay for that. That's a bummer, but it's a cost of doing business. We just make sure we account for that sort of stuff. But I don't personally deal with any of that stuff because I've hired a property manager. And a lot of people ask me, well, Dustin, how do you afford a property manager? Well, I said a little bit earlier, I don't have to get a job to get a property manager. My tenants pay for that. And I don't buy the property unless the property management is accounted for before I buy it. With that, still making $250 a month in passive income. That's like I said, my suggestion. But with tenants, there are going to be problems that come up, but we account for those problems in our expenses. There's vacancy factor that we account for, like how much of the year will it not be rented? Also repairs, also capital expenses, like if a furnace goes out. So we account for those expenses. And the biggest thing, the reason why I like $250 a month as the minimum for me and my students is because it's a huge buffer. Now, I feed my family with the passive income from all of my properties. On top of that, if there was something big that happened, a roof goes out. Well, if you're only making, let's say, $100 a month in passive income from every property, that's only $1,200. If you're making $50 a month in passive income, that's only $500 extra. Well, you don't want to have to dip into the money you feed your family with if you have a big problem. So that's why I make sure everything's accounted for. But man, I love having property managers. I wouldn't say that they actually enjoy it. They enjoy managing properties. I have property managers, lots of them, and they manage all my properties, and they do a fantastic job. So I don't have to do that. I can go back to play with my kids.
Crystal, you talked about the importance of having a team. Are property managers part of your team so that you
Yes.
don't have to deal
Oh,
with the
yes.
tenants?
Well, and for me, it started with my realtor too. The first time I needed to find a tenant, I did not want to deal with the no-shows for people that wanted to come see the place. I didn't want to deal with the negotiate. Like there was so many things I was like, I don't have time to sit there waiting for people to come. So that was my aha moment when I hired my realtor to look for tenants for me, because that's also one thing that people overlook. First, it's all about the property. Like, is it in your budget? First of all, too, do you have an emergency fund before you even start this venture? Because you need your emergency fund first, just in case something happens that got overlooked on the inspection or anything else, because that you don't want to start off on an ugly foot if there is a plumbing leak or anything like that. And whoops, you don't have any money to cover it. So always start with that emergency fund in the first place, too. But that was my aha moment that, hey, I don't, turns out I don't have to sit and wait on people. I don't have to do all the credit checks and the credit reports and call all their references, like I didn't want to do any of that stuff. I didn't have time. I would rather watch TV. Dustin said he'd rather play with his kids. I'd rather just sit and watch TV than do all that kind of stuff. So I worked it into the budget to be able to afford those things. And then as long as it met my threshold with all my extra, my privilege, my privilege stuff that I wanted, then hey, it's a win. It's a no-brainer. Let the math tell you whether it's a yes or a no. It's the math. And see, we're engineers. So yeah, me and Eric, we're on the same page for that number. And I do
got
too.
you.
I even make spreadsheets for different things. Like I created a contractor comparison spreadsheet just so we're comparing apples to apples. Like, oh, this is what each contractor said was plumbing and what was included or what was not included. So you get to you're learning, okay, this estimate is way outside of the scope of what a plumbing job like this should cost. So create your own spreadsheets and things like that too, for your own information understanding, and you get smarter in the process too.
Rich, any change from when you were overseas? I would imagine that you had to employ a property manager, but now that you're in Montgomery, any change in the way that you approach it?
Well, I switched to self-management once I was back here. I don't recommend that for everybody, but I'm somebody who loves, I don't know, I love real estate. I was always kind of like managing the property manager. You have to do that at times. You need to kind of watch and make sure expenses are in check and make sure that what they're doing makes sense. Once I was back in Montgomery, Alabama, where all my properties were, they were all here. I decided to take over, and I recommend using property managers, but you got to have the right property manager. Now, earlier, I think Andy, you said something like, the key is having a good tenant. That's probably not the key. The key is probably having a good property manager and screening for the best tenants. But what I'll say about me doing it myself, because I live here and because I have experience, I essentially spent the time to become a good property manager. I save the 10% fee, but I also save a lot because I keep my expenses a lot lower than my property manager does. And I also save a lot make a lot because tenants stay a lot longer than they did when I had a property manager. I think I'm also better about handling deciding what kind of things to do in between tenants, because a lot of property managers, to keep their owners happy, kind of do the bare minimum. But over 5 or 10 years, that can lead to a lot of stuff. So another thing that I'll say is managing 1 or 2 properties where you live a big deal? It is not a big deal. It would not be hard. I'm managing 30 properties, a little bit more than 30 properties. And I'm beating the 4-hour work week with this. I mean, it's less than 4 hours a week for me. I think at times where there's turnover, there's going to be more, but there isn't that much turnover. And actually most of my turnover, if it happens at all, it's seasonal. It's like in the summer or something. And I have some pretty quiet weeks. And, a lot of it's done by text. I don't do showings. I do online leases. I do online applications. All my payments are electronic. It's actually pretty easy.
That's really cool to hear. Eric, how much of your rentals are through Airbnb short term versus having longer term rentals?
Yeah, I was just going to speak to that because I think my experience here is a little bit different than everyone else, but similar thing. It's like same kinds of approach of automating things, having the right people in place. With the Airbnb side of things, we've got a supply manager, we have a quality assurance person, property manager, cleaners, and then handyman on call. And I think the biggest thing was just getting those systems in place at the beginning. When I first started, I tried to do all of it myself. And I think that's the like classic beginner real estate investor mistake where it's like, no one else can do this better than me. That is the worst thought I had, right? If a cleaner's been cleaning for 10 years, of course, she's going to clean the Airbnb a lot better than I can. Same thing with property management and all of that. And I think what I found at least is the opportunity cost of my time, like continuing to manage properties, even though it wasn't that much time, it's just like the sporadicness of when things popped up, especially for Airbnb. There's always like random things happening at random hours. And with so much turnover, it like hours wise might have added up to like 2-3 hours a week across the 7 properties, but or 7 units. But it just like, it kept making me context switch during the day. So at some point I'm like, okay, you know what, let's hire a property manager instead so I can focus on growing other parts of the business, starting to explore development and all those other things. And one last point I want to add is I've had a lot of other beginner investors when they're first getting started, they have one bad property manager experience and then they forever write off property management. That's typically not the case. It's more so that you just didn't spend enough time vetting and finding the right person. And instead of, canceling it out right away, go back and try again, because I promise you there's someone out there for you.
Go ahead, Rich.
Yeah, I'd love to add on to that about the property manager. I think in my case, I had a property manager for a long time, 2013 to 2020. And there was always like, giving him feedback, telling him what you'd like, telling him what you want to see, letting them know that you didn't think that was the best way to handle that. And I was able to, I think, always steer things in the right direction, and they were able to correct. And I think if they weren't able to correct, then you might have to fire them and find another property manager. But I'm just saying that's possible. You can give your feedback, let them know what you need, tell them what's wrong, and a lot of times they can correct.
A lot of great advice. So thank you for that. We're going to move on to segment 4. Let's demystify REITs, a game changer in real estate. Imagine owning part of a skyscraper. That's equity REITs. They own properties generating income from rent. Mortgage REITs invest in mortgages and earn from interest. Why REITs? First, dividends. They distribute 90% of their taxable income, making them a reliable income source. Second, diversification. Real estate often moves opposite to other markets, offering a buffer. Third, professional management without landlord headaches. Plus liquidity. You can trade REITs like stocks, but caution is key. REITs are sensitive to interest rates and market conditions. Each type has its own risks, from property sectors to economic cycles. And remember, dividends are generally taxed as ordinary income. In under a minute, you've got an overview of REITs, what they are, why they fit into your portfolio, and what to watch for. It's real estate simplified. So I'm kind of curious, for this group who is very actively buying real estate properties for investments, managing and having rental income, by a show of hands, who owns a REIT? That's what I thought.
I knew that was the answer.
So this could be a very short segment.
Oh, that's hilarious.
Well, I do want to share how before I started investing in real estate, I did invest in REITs. I thought, oh, this is great. I get dividends. If the stock goes up, I make money. And then, like I said, the dividends. So there's two ways. But here's the biggest reason why I don't invest in REITs is when I buy one rental property, anybody, if you buy one rental property, you make money 6 different ways. It's absolutely really amazing. First one's passive income. Obviously, you rent it for more than your expenses are. Next one is equity capture. We buy it for less than it's worth. So we want to make sure we capture equity. Another one is market appreciation. We know over time, the value of the property goes up. Forced appreciation, we put a little bit of money into it. Let's say we put $5,000 into it, make it worth $15,000 more than we bought it for, than the $5,000. So we captured $10,000 there. We also have mortgage buy down. I love this one. Remember, I don't pay my mortgage. I don't pay my interest. My tenants pay for all that. So that is money that's just basically being captured as well. So mortgage gets brought down. And on top of that, tax benefits are amazing. Deferred, we have the, depreciation is absolutely amazing when you have a cell phone. If you travel anywhere, like anything in your business, you're gonna be making money. So those are 6 ways, just really quick overview. And when I buy a REIT, I maybe make money if it stock goes up. I'll make money in the dividend, which is nice, but I make so much more money when I invest in myself. And the biggest thing I think Eric said is I had to get education myself. Like I need to actually do it right. In fact, all of my students, like I love fast tracking their success by telling them I screwed up doing this, this, and this. So don't do that. Do it this way because it's right. And with hundreds of, actually almost thousands of students now, it's great seeing that now they don't have to invest in a REIT. They don't have to give their money to somebody else and say, you invest it for you. I love having control over my money and making sure I'm going to make money every single minute of every single month of every single day because my properties are what's making me money. So those are the big reasons why I don't invest in REITs.
The 6 ways to make money with real estate. That's the mic drop from Dustin. Yes, Eric.
I want to share a horror story, not about a REIT, but about a real estate fund that I invested into. And I think there's a chance my mom and dad are listening to this, and I don't think they know this, so this will be the first time they hear as well. But like 2 or 3 years ago, I invested about $100,000 into this luxury real estate fix and flip investment fund down in the LA area. We're actually still in a lawsuit right now trying to get that money back. But basically, this company and this fund, they'd done maybe like 7 or 8 successful exits. Each of them exited about 20-30% ROI. So things were looking good. They created a 5-year fund. And then I don't know exactly what happened, but the general partner of the fund, his brother passed away. And I think with that, his priorities really shifted in life. And like all the projects fell apart. So we've been in a lawsuit since maybe March or April of this year trying to get that money back. But from what I know, there was over like $15 million in that fund. So a lot of people are not very happy right now. And this is like a perfect example of why I like to take on my own deals now, right? Because I control the buy box. I control what numbers I'm looking for. And like, sure, there's things that are going to happen that are out of my control. But at least something like this isn't going to happen, right? So, mom and dad, if you're listening to this, don't worry. We're about to make that 100K back on this next deal right now.
Thank you for the cautionary tale. I think as the stock guy, as part of this panel, I will just share that I think that even REITs, people need to be careful because investors oftentimes they just say, oh, real estate investment trust, it generates, it pays a great dividend, it's going to generate income, and they forget that it's a stock and it behaves like a bond substitute. So if you have interest rates, that is going to impact the stock price of the REITs. And the other thing that you really have to be careful about is that there are management teams out there who are not doing what they're supposed to be doing. They're using the REIT as a vehicle to raise cash in the capital markets. They pay themselves handsomely. Not everybody does this, but there are some REITs that I know this is taking place. The management teams are getting rich and they're kind of fleecing hospitals in different investments that they are buying. Not to the benefit of their shareholders, but to themselves. So you have to be really careful as an investor to understand the balance sheet and to understand the margins and are the dividends going to be sustainable or is the company just not being run well? And then it's not going to end well for anybody. So with that, let me go to segment 5 and we'll bring it home. In the realm of real estate investment, The human element often tells the most compelling stories. Take Sarah, for instance, a single mom who ventured into real estate with a small duplex. She now owns a portfolio of long-term rentals. Her secret? Leveraging property management services to balance her busy life. Then there's Mike, a tech professional who used data analytics to pinpoint high return on investment locations for out-of-state investments. But it's not all roses. There are cautionary tales that serve as stark reminders of the risks involved. In Ontario, investors experienced a 20 to 30% decline in property values within just a year, leading some to financial ruin. So what are the timeless lessons here? According to experienced investors, due diligence is non-negotiable. Always research before you leap. Risk management is another cornerstone. Be prepared for market volatility and have a plan to mitigate risks. In essence, real estate investment is a journey filled with highs and lows. It's a path that demands due diligence, embraces risk management, and values the wisdom of those who've walked before you. Dustin, you're really big into education. You've got a great community that you work with. Can you share some of the lessons, like the human stories that you see on the positive side? And then I guess also, I'm hearing from this discussion that being a real estate investor is very much about personal growth. You're always learning. You have to be willing to make mistakes, and you're learning all the time. Can you speak to that?
Oh, absolutely. You're learning all the time. You should be networking all the time. You should be talking to as many people as you can. You should also be telling people that you're an investor. That, man, when I started telling people that I was an investor, in fact, we're still working a job. And it so happened that 100% of my money still came from my job. That's now my part-time job. I became a full-time investor. Started telling everybody that I was an investor because I knew that as soon as people saw me as an investor, I'd have more deals. So definitely you want to keep educating yourself. You want to keep growing. Now, as far as like cautionary tales, I'll give you one from myself. Like, I followed what the gurus told me to do, and my property manager started stealing from me within 6 months. I mean, it was absolutely horrible. And if I would have just hung my head and said, woe is me, like, this doesn't work and it will never work, well, I wouldn't be here today. Like Eric said, like, I needed to, and I realized, because I've always been entrepreneurial, I said, let me approach this from a business mindset. So instead of having a property manager, I just grabbed somebody across the street. This is what I did. I said, oh, you say you're a property manager. You got a pulse. Okay, you're probably good and trustworthy. Let me have you run my properties and run my business and make me money. Turns out that wasn't the right way to do it. The best way to do it is to literally interview multiple property managers, interview them multiple times so that they're going to be running the business for you. Another quick one that I'll give you is, as I was building my business, I was buying property after property, like capital was keep going out, but then I was making money at the same time. But I took my eye off the ball. My goal was to quit my job, become financially independent, but I started making a little bit more money, and I started spending money like I should. I started buying things I didn't need, going on trips. And with that, I had also bought like 3 properties. And at the same time, I had like 3 properties get evictions. So I had so much money coming out. And I was, at the first time, I was like, oh my goodness, like I have so little cash coming in. And I remember, instead of getting thousands and thousands of dollars a month coming in, I remember one check was like $215. I was like, what? No, it should be thousands. And I had so much money coming out. So my, I guess, cautionary tale is definitely build the business first, hire the right people. And at the same time, what my big suggestion is, when you start making passive income from your properties, don't spend that, save that, because it's a snowball effect where it gets bigger and bigger and bigger. The more properties you buy, like I said, if you get to 20 properties making you $250 a month, that's $60,000 a year that you could then use that every single year to buy another property and buy more properties. So cautionary tale, keep your eye on the prize of whatever it is. Like, if it's just being financially independent, travel the world more. For me, is quit my job and become successfully employed. Go down that route. And above all, get trustworthy people in your business working for you, because you can't do this alone. Even if you try to manage it all yourself, you're going to have, like, unless you're like 30 plus properties with Rich, you're not going to fix up every single property. You can, but there's not that much time in the day. You got to get the right people, hire trustworthy people that are going to do the work for you. And so with that, you're actually going to be skipping over so many problems and hurdles that I actually went through. So above all, get the right people in your business and keep your eye on the prize.
It sounds like everybody needs to be a very good manager. How do you guys decide when things aren't working out and you need to make a change? You need to fire somebody. Like, is that by gut? And how many second chances do you give versus you're like, I know I need to make a change and be decisive? Rich.
So when you say that, in my case, it makes me think of tenants, right? I mean, it makes me think of how late do you let somebody get? Now, of course, if you hire a property management company, they should have a very good system for doing that. But I've always found personally in managing my own properties that being a stickler about a late fee and being a stickler about like sending out eviction notices, not necessarily eviction notice, but like the notice of like, hey, you're going to get evicted if you don't catch up. I kind of do those things pretty early, right? I guess as soon as I can, as soon as I legally can, I just send them out. And I tell everybody in a very nice, friendly way, like, hey, this letter goes out. As long as you pay within the next 10 business days, it'll be fine. And I think that I kind of have a high standard for that. And most people just fall in line and I don't have problems. And then when people don't fall in line, then sometimes they have to get evicted. But I think by having that kind of tough standard, if you start to sort of let that go, like, oh, they've got a great sob story, I'll give them another month. They've got a great sob story, I'll give them 6 months. Like you're 9 months behind and you're starting to believe and you realize that they've probably been lying to you the whole time. But that same thing can happen from a contractor that you have. That same thing can happen from a property manager that you have, as it looks like Dustin went through. I think that you kind of have to have this thing in your head has to go off where it's like, I've given them as much of a chance as I can, and now it's time to take serious action. And of course, for me, I had a 20-year military career, management, leadership, and all that. So
I want to jump in
I'm
too,
used
Rich,
to tough conversations. Yeah, go ahead.
I think you're 100% right on. And I think everybody will agree with me on this, so everybody, you need to realize this. Real estate is not about properties. Get it out of your head that real estate's about properties. It's not about a property, it's about people. Same thing, a business is not about a product, it's about people. Life is not just about experience, it's about people. Everything in life is about people. That's why, most of us here on the panel know each other already because we're all about people and we love helping each other. Now, real estate, when I say real estate's not about a property, it's about people. Every single time you interact with anything in a property, it's with somebody else. If you're going to be buying a property, the seller has needs. If you're a good buyer and you can help them with those needs, they're going to sell it to you. If you have an off-market property and they like, I just need to get out, I need to take care of my grandma, blah, 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 whatever it is, you can hopefully help them. Because once you figure out the person, then you're going to be able to figure out how to help that person. Same thing with your contractor. Your contractor is another person. If you're able to talk to them, see where they're coming from and understand them and make sure that they're doing the business right for you, remember, it's about people. But here's one thing I will absolutely give you. I learned this the hard way. So here it's 4 words when you're going to be hiring somebody and you're going to be managing people. It's hire slow, but fire fast. Hire slow, fire fast. So when you're hiring slow, that means you're taking, let's say, a month maybe to find the right property manager. Maybe you're taking 2 weeks, whatever it might be, but you need to not just, like I did, I just grabbed somebody and said, hey, you're a property manager, come manage my properties. Now with that though, you hire them and you interview them multiple times, as well as you ask them many, many questions and you figure out if they're the right person. But the last thing, you fire very, very fast. Now, I do give people a second chance. Like maybe they just didn't know, maybe they didn't understand my systems and procedures and processes that I give them to do, and they weren't able to follow it. I do give them a second chance because I think everybody deserves a second chance, but no third chances. Like you're done. I literally fired. In fact, I just got rid of a property manager probably about a month and a half ago. It was irritating because they had a good amount of properties and I had to change everything over, but I fired them fast. They were done. And so with that, you cut good money going after bad. You don't want to do that. You want to keep making sure that you're moving forward. So hire slow and fire fast.
Crystal, any final thoughts?
Well, definitely. We are in the people business at the end of the day. We're landlords, we're individuals, we're not the big guys, we're the big people. And when you're investing in these properties, remember, it's a neighborhood. You're investing in a community. We were talking about something we saw on TikTok where some contractors came in, they demoed the wrong house. Luckily, one of the nosy neighbors stopped them. They were like, "Hey, what are you doing? We know who lives here." So imagine if you're like this absentee landlord, they don't know you, things can happen to your property and nobody will say a word. So if they don't know who you are, you're giving yourself a bad rap. So you're investing in a community, in a neighborhood, and at the end of the day, you're a person just like they are. So the more honest and down to earth and open, like I love Rich's point about having like look, you're signing this contract. This is what happens. If X happens, Z is going to happen. I don't need the excuses like, okay, but this is what you signed. This is our agreement. Things happen. You can even help, try to get them help with paying rent. There are a lot of charities out there. There are a lot of programs out there. You can direct them to that. But, you need to fill this out by the due date because, time is ticking. And I'm a person just like you are. And you just have to be understandable and a down to earth, approachable person about these are the rules. I like you, but these are the rules.
I like that creativity. Eric, final thoughts?
Yeah, nothing too much to add on that. I feel like I got all the great points out there on hiring and getting the right people. I guess maybe one last thing to add is sometimes the people that you meet might not fit for one job, but that doesn't mean they're not the right person for another job. For example, we had a contractor who, maybe the scope of work was too big for him on the project we ended up firing him on and got someone else for. But actually recently we hired him back on for like a smaller cosmetic job because his crew is really great at that, but they weren't as good at a lot of the mechanical and bigger component type things. So just because a person might not make sense for one job doesn't mean that, you immediately axe them out for everything else. And he's been fantastic on the second job.
Well, thank you. I want to thank the panelists for this amazing discussion this evening on real estate investing. If I may do a quick wrap up, here are my takeaways for the Inspired Moneymakers. Number one is to learn the basics. We learned that real estate investing can be a good way to make money in the long run. Success in real estate is not luck. It's about knowing what's happening in the market. It's about knowing yourself. It's about learning all the time and being willing to go through ongoing education and making smart choices. Number two, we learned that while it's important to pick properties, it's also about the people. You need a team. You need to be able to manage the team. You need to be able to manage tenants in cases where you don't have a property manager. So sometimes you do that yourself. Other times you can outsource it. And to do well in real estate, you need to be good with money. You need to manage risk and you need to pick good locations and do the math before making a purchase. And then number three, rental properties can make you rich. They can cash flow. We learned that owning rental properties can help you to become wealthy. But it's not just about collecting rent. You need to be careful when choosing tenants, setting the right rent prices, following rules, and hopefully working with people that respect those rules. So rental properties can finally grow in value over time, helping you to become financially free. Once again, thank you to all the panelists. I encourage everybody to visit them and support them. Let's see if I can get this right. Rich Carey has a great TikTok channel, and you can also find him on YouTube at Rich on Money. Eric, I wasn't sure what link you wanted to have. I know that you have a compass.com
realtor. Instagram is best. Yeah, just hello, Eric Yu. Or if you're looking for more coaching help too, I've got the 9-to-5 escape plan.
Thank you for the help. Crystal, you can find at stackingdeeds.net, among many other places, whether you want to sew or do many different side hustles, which are awesome. Go find Crystal Hammond. And then finally, Dustin Heiner. You can find him at masterpassiveincome.com. Thank you guys all for joining me this evening. I want everyone to mark your calendars for next week. We've got episode 14, Vintage Dreams, revving up the classic car collecting experience. This is going to be another fun one because if you join me for wine collecting, I'm not a guy who drinks wine. I also don't have a classic car collection, so it's going to be all learning. That's November 15th, 6 p.m. on Wednesday. That's Eastern time. Please join us then. In the meantime, please go out and do something that scares you this week, because that's where the magic happens.